Welcome back. The early trade is positive so far today, suggesting investors are entering the last trading week on a positive note, following one of the steepest drops in recent memory in tech stocks after both Tesla and Netflix disappointed and suffered the consequences yesterday. Let's go to our next guest. She is Michele Schneider. She's Managing Director at MarketGauge. Michele, thanks a lot for joining us. What is your view of the tech rally we've seen thus far this year? Are investors getting a bit nervous about tech names in tech that miss expectations?
Well, I'm not sure I would say nervous, but certainly after the traumatic run that we've had this year, you have to think at some point they get oversaturated. And of course, today we have NASDAQ rebalancing, which is targeted towards the Magnificent Seven. So maybe getting involved right now, if you had not been involved, may be a little bit risky. But overall, I think we're seeing a trend that is not going to go away anytime soon, and that's really the trend towards AI.
Tell us more about that NASDAQ rebalancing. The index is undergoing a quarterly rebalancing, is it?
Yes, and basically the goal is to bring down some of the weighting of those big stocks from where they're currently sitting at over 40%, more like 45%, down to around 38%. And along with that today, we have the largest options expiration in history going on. So it could be an interesting day.
You think the theme in tech is AI. Tell us more about that.
Well, essentially, if you think about it, the companies that are really at the premier of it, which would be Meta, NVIDIA, Amazon, Microsoft, and Google, they're all really competing for the space in AI, and AI is saturating our lives more and more on a daily basis. So it seems to me that that will be something that will continue. That doesn't mean we can't see drops in prices along the way, but at this point right now, it's the most exciting technology, and I personally got to use the Meta system recently in AI, and I thought, oh my God, this is really going to blow the future generations out of the water in terms of what they're going to use to do everything, travel, shop, etc.
For a lot of investors, the big question now is, after the run we've seen in the stocks that you've just mentioned so far this year, is this the time to get in or not? Should I wait for a pullback? Should I wait for a meaningful pullback before buying or establishing positions in stocks, for instance, like NVIDIA or Microsoft?
Well, considering we haven't had those reports yet, it would probably behoove people at least to wait for the earnings, because we saw what happened with Tesla, for example, and Netflix, if you wanted to include that as one of the top stocks. They dropped precipitously after their earnings, which probably gave a better opportunity risk-wise. But at this point right now, I think there are other factors to really watch. And interestingly enough, if I had to choose one thing for people to keep their eyes on right now, it would be probably the long bonds, as we see through the TLTs, or the 20-year plus long bonds, because they often are a great gauge for trouble. They haven't been a flight to safety, obviously, through 2022. But now that many people see the Fed either quite close to the top of raising rates, or if not, like right there now, soon to be, if those actually start to move up or yields continue to soften, it could actually turn out to be more negative for the tech space and more positive for some of the other areas, and could spell recession that really at this point has been completely avoided.
What is your forecast on a recession? More and more we hear people expressing some level of optimism that the Fed may be able to engineer the much hoped for soft landing, or at least something like it, a mild and short recession.
Well, that's a great question, because right now we have had the consumer basically almost single-handedly keeping this market together and the economy together with a robust demand in the face of everything, inflation as well, higher interest rates, and also the fear of recession. So basically my feeling is that as long as we see the demand remain robust, and we have headwinds that we have to watch out for, strikes, for example, more inflation, weather, geopolitical stuff. If we can keep the consumer in there, we may get that soft landing. But we know that consumers can be fickle. And so if we start to see things unravel on any of these areas we just talked about, I would probably say inflation being the biggest, then it's possible we'll go from sort of a reflation trade to going right into recession. And I'm keeping my eyes on it. But at this point now, the call is for maybe a softer next quarter, but ending the year well. We are 2024 election, and that's generally a really good year. So there's no reason to be fearful at this point. We'll revisit it in 2024 if things don't necessarily improve on the inflation front.
So with all that uncertainty in the economic outlook, what is your view of the consumer stocks, the staples and the discretionaries?
Well, at this point, I'd rather go more for the staples than the discretionary. They got beaten up over the last few months as everything else started to rally. And we saw XLY, for example, take a nice pop. But I think that we cannot discount the higher costs, particularly right now. If we take a look at the energy and the oil sector, which was basically dismissed over the first 6 months of the year, now we have oil back at around $76, $77 a barrel, with threats of supply and demand much greater, particularly from China, that people expected. Natural gas is something that's been very cheap, but could also go up electricity costs. So as far as I'm concerned right now, those staples, people may switch to going to buy the things they need. And we're particularly looking at basic materials because there's another interesting thing that's going on with insurance companies that are pulling out of states that have extreme weather conditions like Florida with floods and other areas like in California with fires. And that means that there will be pressure for people to be able to have access, or companies to have access to these basic materials. So we're looking at companies like BHP and Rio Tinto and also Cleveland Cliffs Mines, things like that, staples like, even Costco and Walmart, which have done very well. Target got beat up. That could be an interesting buy. More, I think, might be a focus as we get into the next quarter on what we need as opposed to the toys that we've been buying.
We just showed viewers a screen of some of the stocks and sectors you like. At the top of that was Raytheon, the defense contractor. The war in Ukraine has redefined a lot of things in the world we live in. Is that one of the reasons you like Raytheon?
Well, yes. I mean, definitely we have built a lot of money up in the military, and we're giving a lot of money to the Ukraine. And a lot of that stuff is coming from Raytheon, which, by the way, reports next week. So it's in an interesting place price-wise, and I think it's certainly something to keep an eye on, particularly if it can cross back over that $100 mark. It's trading at around 97 right now. Yeah, I mean, Boeing, General Electric, anything that is really basic producing for the industrial manufacturing, defense, and even some cybersecurity, I think continues to look like a good buy.
And you also like Biotech, both a Biotech ETF and a couple of individual names as well. Are these counter-cyclical stocks? These are stocks that typically don't move in step with economic trends. They move in step with how well their drugs are doing in test trials.
Well, a little bit of both, because there is more economic money put towards development, research and development in biotech when things are doing well. And of course, labor would be a part of that as well, hiring people. But yeah, I like Gilead. Gilead looks like it's ripe for another move up. And Teva is something that we've been in. It's a stock that's a pharmaceutical stock out of Israel. They do more generic type of drugs. But we think that after the dormancy that we've seen in that biotech space, particularly if you look at IBB, which is the ETF, it's clearing some key resistance right here and could have a run either in tandem or in spite of whatever happens in the rest of the market.
Okay, why don't we finish with gold? Earlier this morning, we showed our viewers a look at the gold price. It was above that much hoped for on the part of gold bulls, $2,000 threshold. The big question, and there it is again, $2,003.50 is the current price of gold as reflected in the December contract in New York. Gold investors who are long gold very much want to see 2,000 plus for the remainder of this year and beyond. Can it do that?
Absolutely. And I don't know if I want to see it because obviously there's implications to that. But I started out this year thinking that gold would double, and that was when it was trading at around 1,600. Now, of course, that might have been a little bit too enthusiastic in terms of the price. But now that we're clearing 2,000, I see no reason why it can't go at least to 2,500 to 3,000 and maybe higher, because we know it's an extremely emotional play. But the question you have to ask is why is that happening? The dollar's a little stronger today because of the yen, but nonetheless, it doesn't really seem to care very much gold what anything is doing, and that's, to me, the most concerning, because obviously we know gold will go up if people don't know where else to put their money and they feel that that's the flight to safety.